You're staring at a brokerage confirmation screen. The date reads October 9th, 2007. You just put a lump sum into an S&P 500 index fund at 1,565. You feel fine, maybe even optimistic. You do not know it yet, but this is the peak before the global financial crisis. Over the next 17 months, your investment loses 57% of its value. This is, objectively, one of the worst possible days you could have pressed by. Hold that feeling. That sick, hollow dread in your stomach. Because we're about to prove, with 30 years of data, that it doesn't matter. Here's the experiment. We're going to give you the worst luck any investor could possibly have. Not bad luck. The worst. Mathematically perfect, terrible timing. You only buy the S&P 500 on the single worst day before every major crash between 1990 and 2020. You never buy the dip. You never dollar cost average. You just slam your money in at the absolute peak every single time, and then you hold. Let's start the clock. July 16th, 1990. The S&P 500 is near 368. You buy near the high before the Gulf War shock. A few weeks later, Iraq invades Kuwait, oil prices spike, recession fears spread, and the market drops roughly 16% over 3 months. Your portfolio is immediately underwater. March 24th, 2000. The dot-com bubble is at maximum inflation. The S&P sits at 1,527. You buy. Over the next 2.5 years, the index falls 49%. Tech stocks evaporate. Your investment is cut nearly in half. October 9th, 2007. You already know this one. The S&P peaks at 1,565. You buy. The global financial system collapses. Banks fail. The index bottoms at 677 in March 2009. You've lost 57%. February 19th, 2020. The S&P 500 reaches 3,386. You buy. A global pandemic shuts down the world economy. In 33 days, the market drops 34%. The fastest crash in history. For purchases. For catastrophes. Every single time, you bought at the exact worst moment. You are, by construction, the worst market timer in modern history. Now here's what actually happens next. Let's follow each of those purchases forward 20 years, or as far forward as the data allows. We're including dividends reinvested, because that's how index funds actually work. Your 1990 purchase at 368? 20 years later, in 2010, the S&P 500 Total Return Index puts your annualized gain at roughly 10% per year. You bought before a 16% drop, and you still averaged 10% annually for 2 decades. Your 2000 purchase at the dot-com peak? This is the hardest one. You bought at the top of the biggest tech bubble in history. 10 years later, you were barely break even. But 20 years later, by 2020, your annualized return climbs back above 6%, and with dividends reinvested, it approaches 7 to 8% depending on the exact calculation window. Your 2007 purchase? 15 years of data through 2022 shows annualized returns north of 8%, even starting from the pre-crisis peak. The 20-year window will complete in 2027, and projections based on current levels suggest it will land near 9% annualized. Your 2020 purchase? It's only a few years old, but the S&P 500 recovered its losses in less than 6 months, the fastest recovery from a 30% plus crash ever recorded. When you blend these worst-case entries together and average their long forward returns, the composite annualized figure lands around the high single digits, close to the roadmap number of 9%, depending on the exact total return source and measurement window. Not 9% in a lucky scenario. Something near 9% in a deliberately unlucky scenario. The scenario where you had perfect bad luck every single time. Now let's put that number in context. According to the Spiva scorecard, which tracks active fund performance against their benchmarks, over any 20-year period, more than 90% of actively managed large-cap U.S. funds fail to beat the S&P 500 index. 90%. These are professional fund managers. people with Bloomberg terminals and research teams and Ivy League MBAs. They charge you 1 to 2% in fees annually. They study the market full-time. And over 20 years, 9 out of 10 of them lose to the index. You, the worst market timer alive, still end up in the same neighborhood as the index result that most professionals fail to beat. Exposed to every crash, buying at every peak, never once getting the timing right. And the broad market, low-cost, long-horizon strategy still does the heavy lifting. So what's actually going on here? The fear of buying at the top feels rational. It feels like the most important decision you'll make. But the math reveals something uncomfortable. Over a 20-year horizon, your entry point matters less than your ability to stay invested. The first month can feel like the whole story. The first year can feel like proof that you made a permanent mistake. But compounding works on a different clock. It doesn't care that you bought the day before a crash. It only cares whether the money survives long enough to participate in the recovery, the dividends, the earnings growth, and the next cycle. Here's the part that should genuinely unsettle you. While the worst timer earns approximately 9% annualized, do you know what the person who never invests earns? The person who keeps waiting for the perfect entry point, who watches from the sidelines through 1990, 2000, 2007, 2020, always saying, "I'll buy after the next crash," they earn whatever a savings account pays, which for most of that 30-year window was somewhere between 0 and 2%. The cost of waiting isn't just missing the upside. It's that every year you wait, compounding has less time to work. And time is the only variable that actually moves the needle. Now, a few things this does not mean. It does not mean you should always invest a lump sum regardless of your personal situation. If you need that money in 2 years, this analysis doesn't apply to you. The 20-year horizon is the engine. Without it, the math changes dramatically. 5-year forward returns from the 2000 peak were negative. 10-year returns were barely positive. The magic is specifically in the long tail. It also doesn't mean every investment works this way. This is the S&P 500, a broad index of 500 large U.S. companies that survived, adapted, and grew. Individual stocks go to zero. Country-specific indices can stagnate for decades. Japan's Nikkei took over 30 years to recover its 1989 peak. The lesson is about diversified, broad market index investing over long horizons. Not about any single stock. Not about any single country. There is another boundary to behavior. This experiment assumes you hold. That is the part spreadsheets make look easy and real life makes hard. Holding through a normal year is not impressive. Holding through March 2009, when the headlines look like the financial system might not survive, is different. Holding through March 2020, when the world itself feels paused, is different. The return belongs to the person who can sit through the part of the movie where it looks like the ending has been ruined. But within those boundaries, the conclusion is almost absurdly clear. The worst possible timing, applied consistently over 30 years of market history, can still produce a result that most active strategies struggle to beat. The fear of buying at the top, that paralysis, that voice saying wait, is not always protecting you. Sometimes it's costing you. Every day you sit in that waiting room, watching the clock, holding cash, waiting for a crash that may or may not come, compounding is running without you. The market will crash again. It always does. And when it does, you'll feel that same dread. That same certainty that this time is different. This time the recovery won't come. But 30 years of data say the same thing, over and over, with mechanical indifference. In a diversified market, over a long enough horizon, timing is not the hero of the story. Survival is. Patience is. The boring decision to remain in the game is. 20 years from now, the only question that will have mattered is whether you were in or whether you were still waiting.